How do you copy exactly what corporations are doing with whole life insurance policies that are set up for maximum cash value? It's no secret that corporations, banks, wealthy individuals utilize cash value life insurance policies, and they have utilized them for a very long time. The thing is, when it comes to a whole life insurance policy, there are so many different ways to set it up. You can talk to 5 different agents, 5 different professionals with the same life insurance company and receive 5 different options, sometimes with the same product. It can be very confusing. It can be very overwhelming. Here's the main thing. When you look at corporations that are interested in life insurance products for maximum cash value, they have maximum cash value up front, maximum cash value long term. They view it as an asset on the balance sheet. Going back to that upfront cash value, and this has to do with the asset on the balance sheet, they do not want to make a payment of any dollar amount and see a negative hit right off the bat, especially a large one. If they pay in $100,000, they don't want to see 0, 50, 60% of that $100,000 in cash value right off the bat. The question is, how do I get it as high as possible? This way it does not negatively impact my profit and loss statement. So, as an individual, can you do the same thing? Can you have the same type of policy that a corporation has? The answer is yes. There are differences when you look at some types of corporate-owned life insurance products or bank-owned life insurance products. But when you look at executive benefit planning, what small businesses and large corporations do with their executives, when they take out whole life insurance products on key members, those executives, they're typically traditional whole life insurance policies that are designed with minimum insurance premiums and maximum cash value. It's kind of fun when you actually look at how that design works and what the products look like up front. But what many people are not aware of is anyone can get this. Average Joe can get the same type of policy that's set up as a corporation. Here's the difference. Average Joe, whenever he's interested in a whole life insurance policy, is typically receiving price quotes. If I'm looking at a whole life insurance policy, here's a $1 million death benefit that costs me a premium of X amount of dollars. Boy, is that expensive. I've got to pay how much per year? $25,000, $30,000 for this death benefit? And it takes such a long time to get my money back. Why would I put my money here? This is a common objection when it comes to whole life insurance. Yet with corporations, when we look at how these policies are set up, they're not price quoting it. Instead, the approach is, here's how much we would like to dedicate toward a policy on an annual basis, or here's a lump sum that we'd like to deposit immediately. Sometimes they throw it into the policy in one shot, and then sometimes they'll pay it into what's called a premium deposit account, or that's kind of like a high yield money market that will feed the policy for a number of years. Maybe it's 5 years, 10 years, but they're funding a policy typically for a short period of time. This way they're not obligated to a long funding period. When you see the difference there, price quote versus cash flow. How do we in turn use a policy as Average Joe? So how do we as Average Joe use a policy like a corporation does? The cash value up front. This is typically a drastic difference with the same product. So you can take the same whole life insurance policy. Average Joe is shown a proposal where the upfront cash value is very low, but then a corporation makes the exact same dollar payment and they've got a very cash-rich policy right off the bat. Here's a quick example. This is a 50-year-old male paying in $50,000 per year. The example on your left is a policy with 100% of the $50,000 going toward the insurance premium. So when you think life insurance or any type of insurance, what word comes to mind? I have to pay a premium. That's what an insurance policy is. The fun part about a cash value life insurance policy is you can choose where your money goes. It can go toward the premium, or it could go toward what is called a PUA rider, all these insurance terms. That stands for paid up additions. It's a great way to accelerate the cash value benefit. That's the purpose of that rider. It gives you death benefit too. But here's a basic whole life insurance policy, $50K going in, all premium. There's your cash value right off the bat. Depending on the product, it's often lower than this. This is a 15-pay product where you can pay into it up until the age of 65. But at the same time, we look at this, $50K per year, year one, you pay in 50 grand, you've got $14,000 in cash value. That's over a $35,000 hit. Got a death benefit of almost $1 million, but again, $35,000 hit. The next year I pay in 50 grand, grows from 14 to 42. I don't get that 50K back, not even close. Here we see the total payments. What do you notice? In yellow represents the break-even point. When you have more money in cash value or equity than what you have paid into the policy. So that's a long time just to get your money back. Say this, many business owners and real estate investors that have been proposed whole life insurance in the past did not do it for this reason, because they're sold on the aspect that the cash value is this great area to position money. And it is. There's several benefits to the cash value. It's a safe area to position money. It's liquid. I can access it whenever I want. And it's also tax-free if I don't trigger what's called a modified endowment contract or do other things that could trigger a taxable event. We've got other content on that. But there's a lot of benefits to this. However, they don't do it because they look at this and say, that is a huge lost opportunity cost. Why on earth would I put my money into a product when I'm doing it for the cash value? That's what intrigued them initially, where it takes over 10 years just to get my money back. Not for me, sorry. Only to find out that a policy can be set up, this policy, like this. It's the same product we have here with the same company, same health rating, same assumptions. The only difference is we redirected where your money's going. So same net payment of $50,000, the actual insurance premium is $5,000 per year. Everything else is allocated toward PUA payments. That's that rider that helps accelerate cash value. There's my cash value right off the bat. Like, look at the difference there. $44,000 compared to $14,000. What about your break even? Meaning when you have more money in cash value than what you've paid into the product. Almost there, year 4, so close. Positive year 5 in this example. And depending on the product, sometimes you can get this cash value a little bit higher up front. But we see a world of difference by age 65 when he elects to stop paying into the policy. What's the difference here? It's close to $100,000, about 90 grand to be precise. And granted, he started out with less life insurance over here. He has more at the end of the funding period. He also has more as the years pass, just as we compare the two examples. There's our age 80 benefit. We've still got more cash value and death benefit than the traditional example. My point here is when we set these policies up, or if you're considering cash value life insurance and you're thinking, okay, I hear about these corporations and wealthy individuals using cash value life insurance, something's there, I'm interested in it, but I want to make sure that I get it right. How do I copy what these guys do? And again, specifically focusing on the cash value benefit. The death benefit has value as well. This is often the point of emphasis though. If someone's interested in positioning it as an asset on their balance sheet, as a business, or maybe it's your personal balance sheet. Maybe I want to access it. Maybe it's for real estate investments, whatever it might be. And then the death benefit is great too. But this is what we look at here. So hopefully this was helpful. We've got some other points here, right? Red flags, if we're ever considering a policy, a number of things here. Sometimes we hear, you can't do that. Specifically what I mean is you can't have a policy that's cash rich because it will mech. That is a red flag in my opinion, because we just looked at a policy that was cash rich. Depending on how we design the policy, we can have it cash rich and non-mech, which by the way, is exactly what these guys do. Corporations, when they're looking at cash value life insurance products. Another red flag, less cash value up front equates to more long-term. That's not what these guys do. And a couple other things in there as well. Versus over here, what do you notice? How do I get it right? What do these guys do to get it right? The corporation is going to make a decision on a financial product, if they're going to dedicate money somewhere. Is the CEO or decision maker at that company the only person saying yes or no? No. If you think about a Fortune 500 company, can one person make a decision? or is it typically made by a board? If you work with a bank, so we are privileged to work with a bank that has set up bank-owned life insurance policies. When we met with them before they executed anything, starting with the first meeting, there were 3 individuals, 3 board members, one of which was a former examiner. The other was the co-CEO and CFO of the bank, then another individual who had BOLI experience as well. But they're going to vet the product, and then they meet as a board to make the decision if they're going to move forward. That's what corporations do. Can you do the same thing? Or how can we imitate that as closely as possible? Some other things here. Meeting as a board, why I mention that, is that pulls emotion out of the decision-making process. They're going to request as much information as needed, corporations that is, and they're going to get as much information as they need or as much information as they want. If someone tries to fight with them, if I'm the agent and I try and tell them, oh, you don't need that, the last thing I sent you is good, or I try and talk my way out of it, they're on to the next person. Simple as that. There's a board that's reviewing everything. They're going to look at the net cash value, net death benefit figures. That's their point of interest. Reviewing both the guaranteed values and the non-guaranteed values. Always beneficial to look at the guarantees. They will not look as attractive as the non-guarantees, but it's good to see them just to have awareness of what that worst case scenario is. So valuable there. Corporations make decisions as a group. Third party involvement, very big here. So sometimes they will bring in outside advisors. Individuals will do this too. You've got the concept of the family office. You'll see this with wealthy individuals and wealthy families. Just like a board will review a financial decision for a company, you've got a group of individuals, professionals, attorneys, financial advisors, insurance brokers, real estate professionals that are reviewing everything and making that decision. Here's something that's good, in my opinion. I like this. Sometimes they will ask for disclosure on compensation, and that's okay. A corporation, whatever they want, if the agent or financial professional wants that sale, they're going to provide it. Now, I mention this, sometimes they ask for disclosure because I've heard so many stories when individuals, call it average Joe, asks an agent, hey, what's your compensation look like on this policy? Is there a way I can improve the cash value? And it immediately turns into a fight. Both parties get very defensive. And that shouldn't be the case. Just be as transparent as possible. So if you're considering a policy, it is okay to ask about compensation. Yes, agents need to make a living too. That's how we drive our business, by selling policies. But they're designed for maximum cash value. Do the right thing, and the money will come. That's always been our mindset there. Questions are answered very clearly. There's no uncertainty. There is uncertainty. Questions are hit on again. Like it needs to be crystal clear, which really should always be the case. Before you're looking to dedicate your money somewhere, are all of your questions answered, and do you understand it? Where you can explain it to your relative, to your best friend with confidence. Or if they ask you questions, you think, I don't really know how that works. That's okay because we're not in the profession, but can we explain it to a degree where we get it? You know what I mean? Have you ever felt like that where someone asks you, hey, why do you put your money there? And you're like, I can't really explain it. I don't know. It seemed like a good idea at the time. It's like, hey, you just messed up, man. It's like no one likes that situation or no one wants it. So hope this helps. For agents, here's my tips here. Don't take any of this as an attack because it's not meant to be. Remember that it is the consumer's money, not the agent's. Very important to be aware of that. So when we're working with individuals, it is their money going into a product. Treat them exactly how you want to be treated. I'm not talking about how you prefer to design policies. What I'm referring to here is full transparency. If you wanted to see all of the options and I resist or I try and explain something to you without showing you the options, when it's what you wanted to see, that's typically where a problem occurs. So just be transparent. Why do you think Amazon is so successful in their business model? They show everything and they make life so convenient for the customer. So how can you do the exact same thing? Appreciate the opportunity you're given. That's how I look at it. Any opportunity, no matter how much work it is, never complain about your clients. to them, to others, how you talk about them behind their back is really a reflection on your character, in my opinion, meaning always be positive. Treat people, again, how you want to be treated. That's really it at the end of the day. But do you appreciate the opportunity to work with someone? If they're going to put money into a whole life insurance policy and choose to work with you, of all the agents out there, they're working with you. That means you can generate a commission. Still to this day, if there's someone that I'm working with that says, hey, I'm looking at a policy and they can pay in a small amount, maybe the underlying base premium is a couple $100, which generates a very small commission. It's like, hey, I would bend over backwards for that back in the day, and I still will. And because the reason why it goes well beyond the money. It's helping them set the policy up right, give them the white glove service to the best of your ability, and you never know what will come of that case down the road. Right? We all start somewhere, so treat the people right. We don't want to think, well, I'm only going to work with you, or I appreciate the opportunity if you're putting in a huge amount of money. And again, be efficient with time. Don't take that the wrong way. It's not meant to be the wrong way, but do we appreciate the opportunity when people want to work with us? That's the big thing. I hope this helped. If you're interested in a high cash value life insurance policy and you'd like to set it up like a corporation, we would love to talk to you. If you just want to learn more about how to set these policies up, we've got a ton of videos that can be beneficial. And I hope this helps in any event. Have a great day. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.